she's been feeling the same thing. So Missy Fuller, as you can see, if you just right there, is definitely one of my favorite loan officers. We met initially, I don't know, 5-6 years ago. And the reason we got connected was because I had a deal falling apart. And my clients that were trying to buy had just great income and good job history, all the things, but there was this weird wonky thing that was showing up that was going to make it so that they couldn't purchase. And they were moving here from LA. And I literally got 10 no's from different lenders. And finally we were like, it's just not going to happen. We're going to have to cancel the contract. And I sent a note to my transaction coordinator and said, will you work up this cancellation? It's just not going to happen. And she's like, listen, just before you do that, call this gal, Missy Fuller. She's a miracle worker. And we did, and she got it done. And it was like hitting the easy button. Like, why couldn't nobody get this done? And funny enough, fast forward, whatever it's been, 5-6 years, those same clients are now buying again. They're selling that house and buying again and using Missy again. So anyway, I just, in the last several years, have learned that not all lenders are created equal. Not all loan programs are created equal. Not all brokerages are created equal. And Missy sure seems to get things done for my clients. So Missy, we appreciate you a lot.
Thank you.
And anyway, so that's why I asked her to come on today. I'm going to quite quickly go through this week's mortgage, or not mortgage update, stats update. And let's see, I start sharing my screen. I am pretty excited about some of the things that I have to share, just because it's been kind of a promising week, frankly. We've seen a lot of good movement. So again, month over month, we don't have April's median price point yet, so we'll update that once we do. And as a quick recap, I've kept these screens in here, or this slide in here, so that we can track it week over week. But if you see, we've seen quite a bit of consistency over the last couple of weeks as to the number of homes sold each week, but also how much of the list price are people actually getting, and then the days on market. So that was the last 2 weeks. This week, in April, and just as a reminder, this is all of Salt Lake County and all housing types. So townhome, condo, single family. We had an average percentage of list price to sold price of 99.6%. So almost 100% of list price on average is what the property closed at, and days on market are holding strong at less than 30 days. So if you look at how that compares to last year, we were at an average of 39 days on market. So staying steady there. The number of homes sold has obviously been cut significantly, but week over week right now it's staying steady. This is probably one of my favorite stats right now. As I told you, there's a lot that goes into this statistic. A lot of background information as to why showing time activity may go up or down. However, we now have 3 weeks of the same source of data, right? So even though the behavior needs to be taken into consideration, if you look at this orange line, and as a reminder for some of you who are new this week, what this represents is the actual showing activity on listings. So showing time is a service that our MLS, UtahRealEstate.com, contracts with. And it just is a really streamlined process and allows us to schedule showings on properties directly through the MLS listing for agents. So it's really streamlined. And we probably have about a 75% adoption rate as to how many agents use this tool. So about 6 weeks ago, we saw the beginning of a steady decline. So right here on March 11th, and this is year over year for the same week period last year. So right around March 11th, it nosedived, right? We had 4 weeks of steady decline. And ultimately, the first week of April, we were down in showing activity 42%. And then the second week of April, it started to climb back up. And now look at where we are. We've gained back. We're down from this time last year, 17%. We've gained back half of our decline in just a matter of 2 weeks. So that's really positive. And I can tell you that just being out and about showing homes, the behaviors are matching that. I'm not surprised by that statistic based on what I'm feeling just from clients. So that's really positive. Obviously, that's showing that consumer confidence is back up. And also time of year, right? Like the weather's nice and we've seen a few nice days and things of that nature. So once again, if you look at how is behavior changing? One of the biggest questions I continually get asked, I did a radio interview for the board earlier this week. And one of the questions they asked was, are you seeing prices plummet? And we're just not. Prices around the nation seem to be holding strong. And it certainly seems to be the fact in Utah. So we, as I watch price decreases, so obviously an indication of a fire sale, if you will, or if sellers are getting desperate and just slashing prices, would be that we would see a significant number of the homes that are actively listed with a price adjustment in the downward direction. But the first week, if you remember, we saw about 0.5% of listings had a price reduction downward. The second week, we saw 0.04. Last 7 days, we've only seen 0.017%. So out of all 411 active listings that went on the market, we only have seen 7 decreases. So pretty significant drop there as well. That's exciting. Here's another very positive indicator that confidence is coming back. So look at this spike right here. What we're looking at is how many listings were in under contract or backup status, indicating it had an offer under contract on it, and then went back to active, because that tells us something happened. The contract was canceled, right? So here's week over week, you see about how many listings were canceled. And right around the stay-at-home order, you saw a big spike. And then obviously the top being right here at the end of March. But now we've had a steady decline. People freaked out, canceled contracts, and then went, oh, never mind. Maybe we don't have to freak out. We also, as a state, the Utah Association of Realtors, right here, also created a form, a new addendum, state-approved addendum that we can use that's specific to COVID. And it really helped keep contracts together. And essentially what it did was give people the ability to extend their deadlines if they were under quarantine and couldn't actively do what they do, things of that nature. So I think that helped people just have some ease in their contract as well, knowing that they had that backup to extend when necessary. So, I mean, we're really seeing a lot, again, half the amount of canceled contracts, right? So that's awesome. Here's our trend line for properties actually going under contract. So the orange line is last year, and you just see this steady natural progression as the weather warms up from January to April. You're just steady incline as activity hits spring market. And we were doing the same thing before all of this happened, right? But at a greater pace. We were putting even more houses under contract in 2020 than 2019. And then of course, what happened in March when we got the stay-at-home orders, here you go, right? Well, it's now starting to gain back to get even closer to last year. So really positive information there. Any specific questions from anybody as it pertains to those stats? Hey, Nate, can I put you on the spot?
Go ahead.
This is one of my friends from Philly. He is a realtor out in Philly, and as a lot of you know, I network with agents all over the country. We get together a couple of times a year at events and things of that nature. We refer clients back and forth to make sure our clients are put in really good hands when they're moving out of state. And Nate's jumping on and saying hi. So how are you doing in Philly?
We're good. We're good. We found out from a joint call with James, our coach, that we have probably the toughest restrictions of any of the 50.
Really?
We're not allowed to show a property. Okay, we're not allowed to meet with the seller. It's so bad that we can't even hire a photographer to go take a picture and videos. And they actually have shills out there that are looking to not even give you a fine, but to arrest you. So the brokerage houses are really discouraging. Do people still kind of, they give a lockbox number? Yeah, you get that a little bit here and there, but it's really tough a bit, especially this past week. And what that means is that we have to really figure out how to do it. So to get over that one, we'll have the sellers hire the videographer. And one of the things we use is Matterport. And a lot of people say Matterports were just expensive listings. I've used it for a number of years, even on shells, because I deal with a lot of investors. It saves them time. You know, they can just go through this thing and see how bad it is. So it works, kind of deal. And my videographer also do a virtual staging. And then what I did was I had probably 12 of these, and I made one constant contact, to send it out. And I said, just have an open house at your leisure. And what's going on is that if somebody calls me, an agent, this and that, I'll just keep sending that one out. So they get to see that particular property they asked for, some others. I have somebody right now in town, driving around town. They came from Virginia Beach, 6 hours away, because of the Matterport that they saw, right? And, from that, in talking, they said, and I'm representing the seller, they said, would you mind if we used you as a buyer's agent too? Hey, what do you want? So, they're looking at 6 or 7 different houses. So it's challenging that, but
we just have to be innovative. That's the crazy thing.
Big time.
You really hope. I'm a silver lining person, right? And I frankly had never done Matterport on any of my listings. It's kind of clunky and whatever. But I've done it on every single listing over the last 2 months, and it is just people. The number of people who are writing offers sight unseen because of the tools that we are using right now is awesome. I mean, we just find a way. You create solutions. So I hope that your orders loosen up sooner than later, but also, want to keep everybody safe. So let me call you out a little bit.
So can I give you a couple little tips we're using here?
Sure.
So the Matterport is basically, it's just, it just sets down and what do you do with it? Okay. So my guy actually takes you like a video tour through the place. Okay. My old Matterport guys didn't do that. And this guy's phenomenal. So actually when it opens up, you start walking through as if it's a normal video, right? But you can click it at any point and stop, and he puts all these little blue dots like, Frigidaire this or, that. So that's a big thing.
Are you doing virtual open houses?
I have. There's somebody. I was told somebody. Lafayette Hill does like a. I'll tell you what she does, but no, I haven't done it with that. I send out the email blast like this is what we have. But as far as the virtual houses, I've told that there's a gal out on the main line in Philadelphia, an agent, and what she does is she has her seller walk through the house with an iPad. And as she walks through, and they'll have a meeting like at a certain time, like 2 o'clock on a certain day. And what she'll do is, if people are interested, they'll sit there, and the seller's like walking around with the iPad, looking at this. Somebody might ask you a question. Hey, can you zoom in on this and that? And so it's just, she's having great.
Yeah, that's awesome.
Yeah, so there's that.
A little bit more after this is all done about, swapping ideas from market to market. You guys definitely have stricter restrictions than we do. And our numbers are lower, so that's the importance of, just like our real estate stats are so local, the market's local, the situation's different county to county, state to state. So
We're
Well, that was
encouraging.
the update from a stats perspective, but Missy will jump in and just really talk about what's changed, maybe some history as to where we started in all of this, and what it even looks like. There's so many, I mean, I've heard people say you cannot get a government backed loan right now, which is such BS. I've heard very seasoned realtors say jumbo loans are gone. Just a lot of misinformation. And so if we can clear some of that up, thanks again for helping us get the facts straight today.
Of course, absolutely. So I thought it would be helpful to maybe rewind a couple of months to have a better understanding of kind of how we got to this point today with regards to just interest rates and programs, things of that nature. So you probably all remember end of February, we're hearing about COVID, but it's not really impacting us directly at that point. And it felt like out of nowhere, we had this huge, drastic interest rate drop. So the phones were just off the hook. Everyone was calling to refinance. And it literally feels like that was a year ago, but it was really only, less than 2 months ago. So we were taking loan applications from 8 a.m. till 10 p.m., trying to get as many people locked into these low interest rates, which, it felt like came out of nowhere, but really there were things that were happening that forecasts and things that people saw were coming our direction. So what happened was banking institutions, because obviously this is happening all over the United States, got completely overwhelmed with loan applications. So their operations, our system that we use to take loan applications and to lock loans started to freeze up because so many people were trying to lock in interest rates at the same time. So what happened was banks thought, okay, what can we do to just stop the bleeding? We can't take any more applications. We just can't handle the flow. And so what they did was literally overnight, interest rates increased by about 2%. So they went from, 2 and 3% to 4 and 5 overnight. So people that on Wednesday I talked to and they wanted to go home after work and talk to their spouse and come back the next day and decide if they wanted a 15 or a 30-year to pull cash out, all of a sudden now interest rates are 2% higher. So that created, a lot of challenges for us because people were upset either at themselves or at us for not getting them locked in on time. So that was the bank's ways of kind of slowing things down. Well, in the meantime, the government starts talking about social distancing, and we start seeing impacts of COVID. So you probably remember the stock market just plummeting. And so when that happened, then the feds come out and, of course, decrease the Fed rate to 0%. So I'm sure you can imagine what happened to our phones. Every single person that either was locked at 3 or that I had quoted a 5, my phone just started going crazy because I would like to lock in at 0% if I could. Now, clearly, the rates weren't really 0%. That was the Fed bank rate. But interest rates were higher, and the feds do not control mortgage interest rates. But there are other things that do control the rates, one being mortgage-backed securities. So because of COVID and social distancing, they started talking about businesses closing, which means job loss, which means people potentially defaulting on their mortgage payments. So what the feds did was came out with a bailout, and agreed to start purchasing billions of dollars a day in mortgage-backed securities, which then drove the interest rates back down, because what you don't want to ever have is a struggling economy with high interest rates. That's just
Right.
a disaster. So now, the feds are purchasing these mortgage-backed securities and keeping interest rates really low. So interest rates are great right now. And as far as,
Give us an example on FHA, conventional, jumbo. There's so many variables that go into determining somebody's individual interest rate, but give us an example of where they're at right now.
I would say 15 years are 2.875, 3%, somewhere in that range. 30-year, those are in the low threes as well. So what we're starting to see, which is interesting, is all of the products still exist. What banks and investors are trying to do is limit their risk. So things like lower credit scores, we're seeing higher interest rates. Investment properties, so non-owner occupied properties are a higher risk for a couple of reasons. In this market, renters are unable to pay rent. So investors that own properties and still have a mortgage payment to make, if they have a choice to make a payment on their investment property that they're no longer receiving rent on in the home where they live, and they're going to make that payment. So a non-owner occupied property is considered a higher risk. Jumbo loans is another example. It's a higher risk. They still exist, but what they're doing is those higher risks, they're either increasing the interest rates to make them less desirable, and some of the program guidelines have tightened up a bit. So at Intercap, and I want to do a disclaimer that just in a sense that not all mortgage companies are the same. So if FHA changes a guideline, if FHA comes out and says our minimum credit score is 580, well then everybody's minimum credit score is 580 unless they choose to have an overlay of 600. But an overlay, which is what we're seeing right now, is a guideline or a restriction that individual companies are placing on specific loans that are higher risk to just eliminate that risk a little bit. So for example, we on FHA used to go down to a 580 credit score. You can still go to a 580, but the interest rates are at a point that for that type of a buyer, they probably would not be able to, nor would they want to pay that type of interest rate.
Yeah.
But we are doing FHA loans at very good interest rates in the low threes, high twos at a 660. So one big difference between companies is if you service loans versus not being a servicing company, that makes a big difference. Because we service loans at Intercap.
Make an explanation. So servicing, for those that don't live in our world every single day, essentially you're keeping it on your books, correct?
Correct.
Like Intercap is actually the one with the loan on their books versus holding it for a moment and then selling it to the secondary market, like to a bigger Chase, Wells Fargo, etc. Correct?
Correct.
Okay.
So there are companies that sell all of their loans. At Intercap, we sell a portion of our loans. But in this environment, we have the option of retaining all or more of those loans because the forecast is that things are going to rebound, and when they do, that should happen quickly based on what the economy was prior to this.
Right.
And we're starting to see a lot of that. So Intercap feels like it is a good business decision to continue doing those government loans. So those government insured loans are FHA, VA, USDA. So we're still doing those loans. We're still doing them at good interest rates, same down payments. So that has not changed. And our plan is to service those loans. And at the point that things turn around, then at that point, if they decide to transfer them on the secondary market, they would have that option. So one reason that, so Alicia, you mentioned that there are companies that are taking the stance, or for whatever reason, they may not have the ability to do those government insured loans. One reason is when the bailout was presented, banks that were servicing government insured loans were instructed that if you have a borrower who calls and says, I cannot make my mortgage payment, no questions asked, they get a 180-day forbearance. So for 180 days, if they can't make their payment, no questions asked, they would be granted this forbearance. At the end of that 180 days, if they're still in a position where they can't make their mortgage payment, the servicer is again required to extend that forbearance an additional 180 days. So because of that,
my understanding too is it's bank specific or servicer specific as to whether that means at the fourth month you now have 4 months worth of mortgage to pay, or if it's tacked onto the back end of your mortgage, which is a very important piece, right? I couldn't imagine somebody who has been financially impacted through these 3 months to suddenly have to pay 4 months worth of mortgage. There's no way, right?
Some do at the end of that forbearance.
Yeah.
Right. So I think the majority of banks are deferring it to the end.
Good.
But one thing that is interesting, and I've started to see this, I've actually only had this happen twice, but I had a client call me for a refinance, and when I pulled his credit, his mortgage showed in forbearance. And so I said, well, your current mortgage is in forbearance. And he said, well, I didn't really need it, but they called me and said, do you want me to put your loan in forbearance? And I was like, sure. And so, you know, a lot of servicers are actually reaching out more of a offensive approach and just saying, hey, we've got this available. But what consumers need to remember is that there will be consequences and repercussions, and it's not just free money.
Yeah.
So I've seen that twice actually. And I called yesterday and talked to the president of Intercap to get some insight on what he's hearing, because that's going to be something that we are going to deal with that we have never dealt with in the past, that forbearance, or at least it's not common. So
Can I ask a quick question?
Yes.
So Missy, if your client did something like that, is that forbearance going to affect their credit rating in the long run? Will that be a negative, looked at negatively on that particular person's credit in the future, or is it not reported at all?
So it was reported on credit. His scores were actually impacted by the forbearance.
Okay.
So that it's such a new thing, and things are changing every day. So when I asked Brock, who's the president of Intercap, you know, what's the guidance? What's going to be the rule for these people that in 3 months they're back to work, they're making their mortgage payment, and now they have this forbearance? What does that look like? What's that guideline going to be like? And he said, well, the answer is there is no answer, because they don't know. I mean, it's so new and we're learning things every day. So I had asked him on this particular client, do you think, so AUS is an automated underwriting system that we run all of our conventional loans through. And so, you know, that's a question. Are those loans going to run through AUS? And, you know, because we personally at Intercap have loans that are in forbearance, he's very much in tune with that, and said that what he's hearing is they're going to have to come up with options that either that's removed off the credit at some point, or that it isn't a negative impact. Right now, the guidance is 12 months from the date of forbearance that you're eligible for a conventional loan. That's the current guideline. But he feels like they couldn't possibly leave that guideline in force after all of this is said and done. You know, we want people to get back on their feet and start making mortgage payments. And if that means they're at that point eligible for a refinance and to get a better rate and better payment, banks will need to put them in a position to do that. But there are just things that are starting to come up that we haven't seen, and you know that will continue to be the case. All of this is new for a lot of industries, and but right now we are, as far as Intercap and probably a lot of other servicers we are going to have our best month ever in April. And it was interesting. We had a call yesterday, and it was interesting to hear that our volume is 50% purchase and 50% refinance. So generally in this kind of market with these really low interest rates, we start to see that scale tip, and more of the loans in the pipeline are refinances. But it's really encouraging to see that we are 50-50. And property values, I haven't had any issues with appraisals. As a matter of fact, because our values here are so strong, when we run the loans through the automated system, because the values are so strong, as long as the client's credit and their profile is strong, we're getting a lot of property inspection waivers, which means we don't even need an appraisal. And those are very conservative. You know, they use a conservative automated valuation. So that tells you that our values are holding really strong. I counted the loans that are currently in my pipeline, and 1/3 of the loans didn't require an appraisal.
Wow.
It's really great. It's such a benefit to everyone, you know, it saves the client money, it saves time, we're trying lower risk of appraisers going in people's homes. So that's a really great thing.
What are you seeing? So for a minute there, we were seeing insane delays with appraisals after the refi boom, right? And seeing just a total backlog of appraisals. What are you seeing right now? Has it eased up a little bit?
Absolutely, yes. Although we're still as busy, if not busier, because of those property inspection waivers. And I think that Fannie and Freddie have loosened up a little bit on that. But my turn time now for appraisals are back to just pretty standard. From the date I'm ordering them, I'm getting them within a week easily.
That's great.
So that's really good to see as well.
Here's an interesting thing, and my guess is we don't know the answer to this, but I'd be interested to hear if you're hearing anything just in the chatter in your industry. One of the long-term impacts that I imagine will come from this is the 2-year job history. People, I don't know what the actual guideline from a lending standpoint is, but you've got to have job history, right? And if you have a 2-year requirement of being in that same industry or without gaps of employment or whatever, and they went, 7 years in the same industry, shut down, no job for 4 months, and then back in the same industry, do you anticipate suddenly all those buyers are now out of the mortgage game for 2 years? Or do you think there's going to be some sort of underwriting exception that comes up?
Well, I think those are the things that they're going to have to make exceptions for. Even now, if someone has a gap of employment, there are some loans that are harder than others and some risk profiles that are different. But even now, if you've got a gap of employment, we typically just need a letter of explanation. You know, I mean, some letters are as simple as, I got laid off from my job and I needed a 4-month break. And so we typically have to show at least a 2-year job history. But if there's a gap in there, there's generally exceptions for that now. So I think that that will become even more lenient, especially if it's a result of this, because this is just something that's extenuating circumstances, something beyond their control. So
Right.
that's when you start to see those exceptions. So I think that will be one of those things. Right now, that's one that's been a little bit
like
what
an entire bucket of people totally out of the game for 2 years and not able to buy. I just can't imagine that being the reality.
right. Right now, that part is a little bit harder. That's probably the one thing that we're seeing that's more difficult with the actual loan process is verification of employment. So the standard process is I get a verification of employment at the beginning of the process, and within 10 days of closing, we verbally verify that they still have a job. And literally that's a, hey, is Alicia still working? Now we get that initial verification of employment, and then 3 days before closing, we get another verification of employment. And then the day the documents go out, we do another verification of employment where they specifically have to ask, not only does she still work there, but has her hours or income been impacted negatively? Has it been reduced? So, and then self-employed is also interesting in a sense that we have to typically, you know, sometimes we're using tax returns from 2018 because they haven't filed 2019. So the income we're using is a year or 2 years old. So previous to this, we would have to get a year-to-date profit and loss to see that up through the current time, you're still generating the same type of income. Now they're looking to see this month, last month, I want to see invoices, or, you know, if you're an agent, show me some closings that you've had, checks that you've received, things like that to show that you're actually generating income right now. So that,
what happens if you do that final, you know, day of closing or 3 days prior to closing, you do that final verification of employment and they say, yes, their hours are a quarter of what they used to be. What happens?
to qualify on that. So whatever the new income is, they have to qualify based on that income. Or if we need that full amount, we have to wait until they return to work at that full compensation.
Wow. Yeah. That's tough.
So that's been a little bit tough. But besides that, I really have not seen things get that difficult where people are coming and not able to qualify to buy a home and or to refinance. Things have been really great.
Well, that's what's so interesting about this whole thing, right? There's such a dichotomy there's industries booming as a result of this, and then like completely falling apart. And there's still two sides. It's not like every single person in our economy has lost their income. And I mean, let's be honest, if your hours if you're an hourly employee and your hours just got reduced to a quarter of what they were before, maybe you should hit the pause button, right?
Right.
It's like, that's a painful, I couldn't imagine. I mean, I know what it's like to work with buyers and the emotional journey that is to get that close and to know that I can't get this home. I'm going to have to back out. That potentially means lost money that I spent on inspections and all the things. I totally understand how heart-wrenching that would be, but in the long run, probably the best thing to hit the pause button, right? So
Right. Yeah, I feel like all of the restrictions and guidelines are very common sense. If, you know, you probably shouldn't be buying a $2 million house if you don't have some money in the bank at this point.
Right.
So, I feel like the guidelines are very, very reasonable. And one other thing I wanted to mention that I thought was interesting, on the meeting that we had yesterday, the gentleman had mentioned that they are forecasting that these times where people are spending so much more time at home are going to create a lot of activity when this is over, because people are looking at their homes differently. So in our old world, we spent most of our day at the office. So you go home at night and it's where you sleep at night, and you may not notice certain things that now that you're spending the entire day there and maybe spending time with your kids, you're realizing, oh, this place is way too small. Or, you just notice certain things because you're spending so much more time there. And so they were, he was suggesting that could create additional inventory and people just thinking maybe, this is too much house, or maybe this is not enough house, but just people are looking at their houses differently because they're spending a lot more time there.
It's so true. I've had so many conversations about that exact thing, and I won't call him out, but one of my buyers is on the call today. And when we originally met months ago, living close to a trail system to go running on was high on the list. But it wasn't like, we have to have this in our back door, has to be right there. The movement up in the priority list for that item has become like, we have to be within a certain amount of distance to a trail system. We've obviously realized just how incredibly important that is when you're restricted in what activity you can do, and obviously trying not to go, you can't go to gyms and you can't do all the things, to have that easy access to a trail. So the behaviors and the things that people are realizing are the most important to them, it's adjusting big time. And
Right.
I think we're going to see a lot of pent-up demand for a lot of reasons. In what we were just talking about, there's going to be a lot of people who just had to hit the pause button. It was the most financially sound thing for them to do, to hit the pause button. Or it was health reasons. I have a client who had a liver transplant in February. This whole thing is like, he is in the house. He cannot risk going out. His immune system is very much compromised in trying, because all of his body's attention is trying to grasp onto that new liver, right? And so they've hit the pause button. There's going to be a lot of that. And then obviously, I think we're going to have a lot of people who go, I actually really hate my house. Being quarantined within these four walls with these two teenage kids, I can't do this anymore, or maybe it's too big and I don't want to clean that anymore, whatever. But I think we're going to see a lot of pent up demand this fall.
Right. I do as well.
Yeah. Anything else you wanted to share specific?
No, unless anyone has any questions.
Yeah, I'd love to hear what questions, or if you need further explanation in anything that Missy mentioned. Don't all speak at once. Okay. Well, then I think that's it. I think a couple of things that I just want to reiterate from what you shared is that the programs still exist. Qualification factors may have adjusted. I think it's really important to remember that lenders are not all created equal. I can tell you, working with a lot of different lenders, there have been plenty of times where one company could not do it and another could. So that's important to remember. The other thing I wanted to point out too is, a lot of people, the wounds of 2008 are still really fresh. Even though it was over a decade ago, when you start having stock markets crash and what seems to be a complete crash halt to the market, the feelings, the responses to that feel very much like 2008. But obviously completely nothing like 2008. That was a 4-year study. Like, we saw it coming because of the really poor lending practices and appraisal practices and speculatory buying and all of those things. And one critical thing about that was the very irresponsible lending practices and really loose guidelines and all the things. And so while it feels painful right now in the short term to see some of those guidelines tighten, I'm so grateful that our response hasn't been the opposite, right?
Right.
The industry has learned to some degree. Our response to this cannot be, well, just give anybody who can breathe and can say that they'll be back at work to close on a loan. That is what would in the future crash the system. So I'm really grateful to see we're actually seeing the opposite, which is painful in the short term, but the right thing for the long term.
Right.
So, okay, well, let's pick a winner for our local, you guys know me, you know, I like to support small business anyway, but obviously right now, anything that we can do helps. So we're going to, Maddie, if you tell us what numbers we're choosing between, and Missy.
Okay, let's have Missy pick a number between 1 and 12.
7.
7?
I don't think there's another number, really.
Oh my gosh. Okay, 7. It's my sister. It's Julia Hayes.
Oh, sweet.
Not nepotism.
That's awesome.
Jules, you won. Are you on the call?
Be my girl.
Yes, I'm on the call.
Not my, but
I've never
we're-
actually used Zoom before, so I didn't know how to use it as well as you guys.
Well, Julia and her fiance Jace are building just the cutest townhome right now, and I'm so excited for them. So that's exciting. What small business do you want a gift card to?
Oh my goodness. Well, first of all, thank you so much. I don't even know. What are my options?
Any small business across the Wasatch Front. So if you want to think about it, you can just let Maddie and I know later, and we'll get it to you.
Okay, perfect. Thank you so much.
Yeah, you're welcome. Well, thanks everybody for joining again, and Missy for all your hard work and dedication to the industry. You're always doing what we need you to, so I appreciate you.
you're welcome.
Okay,
Thank you.
everybody
Take
have
care.
a good weekend.
Thank you. Thanks, Missy.
Bye,
Yeah.
guys.